Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Kent Ritter. Now, Kent is the CEO of Hudson Investing, which is a real estate firm that focuses on value add multifamily investments. Now, in Kent's prior life, he was a management consultant, he was a startup owner, and also a corporate executive who then turned full-time multifamily investor by ultimately he saw the clear path of building freedom and wealth through real estate. He just saw that as a much better vehicle than the path that he was on. And in addition to his real estate activities, Ken is also the host of Ritter on Real Estate, which is a real estate syndication podcast with weekly guests discussing the ins and outs of multifamily investing. And so, guys, with that, I'd like to welcome our guest for today's show, Kent Ritter. My friend, how you doing today?
I'm doing great, Kevin. Thanks for having me on the show.
Yeah,
Excited to
I'm
chat.
excited to have you here. Excited to talk shop. I know I was just on your show not too long ago and got the
Yeah.
opportunity to talk about my business. Now we get to dive into yours, right? Get to pull back the curtains and get
Love it.
some insights as to what you're doing in the multifamily space. So with that, Kent, I know there's a little bit more to your background than what I gave there in the introduction. For those folks that don't know you, haven't heard you speak, haven't heard you in another podcast, just don't know your story. Maybe let's back up a little bit. Tell us who you are, ultimately where you came from, how you found your way into real estate.
Sure. Yeah. Happy to tell my story. Yeah, you covered the highlights. I mean, to fill in the detail, I would say I was out of school. I went into management consulting. That was when, ended up starting a management consulting business, sold that business in 2015, and continued on really as an employee after selling that business for several years. And, really it was a couple things that happened in kind of that time of selling that business. One was just having some capital and needing to figure out what best to do with it, right? And as I went and talked to the people that were older and I think smarter than me and asked them, what should I do? Where should I invest? They kept coming back to real estate.
Hmm.
So I talked to several folks and they were all in real estate in different ways. And so it really was like kind of, they say success leaves clues, right? That really for me was like, okay, I got to learn about real estate. And that's how I started deploying that capital from exiting the business. At that same time, I had really started a family. We had our first daughter, and being a consultant, I was on the road 50 weeks out of the year traveling around. And I really had to look at my life and say, you know, am I going to be able to be the father that I want to be and show up like I want to be if I'm traveling all the time? And the answer is absolutely no. And so I had to find a different path there as well. So kind of these life changes plus having some capital and needing to deploy it in the best way were really the things that brought me to real estate kind of all at this same time. And so, I really started like most of us do with what we know or what people around us are doing. And so I started much smaller than with what I'm doing now. I started, flipping houses. I started buying, notes and kind of holding the mortgage on houses. But the problem with all that, and I did that for several years, the problem with all that though is it just wasn't scalable. I wanted to build up a certain amount of cash flow. I wanted to had this idea that, I could create an income stream where I would really never have to work again. Right. And so that was going to take more scale. That was going to take time. And so I realized, it's hard to buy a single family house and it takes almost as much work to do that as it does to go out and buy a multifamily. And so that was really where I came into multifamily. I found some great mentors and really learned that you could go out and buy 100 units under one roof in one transaction. And you could have a bigger, safer, more scalable asset in doing that. And
Hmm.
so that was really the light bulb for me on like, wow, this is where I want to go. Kind of went all in on multifamily. Um, Started doing it on my own, and then up to 20, that was like 2015 to 2019. 2019, I started Hudson Investing because I'd done fairly well. I'd got some good returns. People start asking, hey, how do we get involved in what you're doing? And I started saying, wow, I think there's something here where I could bring others in, friends and family, and we could all invest together. We could pool our money and we could buy bigger and better assets than I could on my own. And so that was really the genesis of Hudson Investing. That was 2019. So now fast forward 5 years, we're 5 years down the path. And Man, having a lot of fun doing it. It's not exactly what I thought it would be, but I enjoy going to work every day, which is something most people can't say. So
Yeah, no, I love that.
I feel grateful.
I appreciate the background. So just let's break it apart a little bit. 2015, 2019, basically using your own capital to
Yeah.
invest in various different projects. What did that look like? Maybe let's talk through that very first multifamily property. Just the opportunity that you
Yeah.
saw. How large was the property? What was the value add component? And just again, that's the foundational piece of it all.
Yeah. I really started in multifamily by passively investing with other people. That
Okay.
was really how I got my start. While I was building out kind of single duplex portfolio, I started investing with others. And I really use that as an opportunity, one, to gain access to great deals, but two, as that learning opportunity. I mean, I
Hmm.
really used those investments strategically with different groups across the country to try to get under the hood, right? And
Yep.
understand how they're doing it, why they do what they do, how they do what they do. And it was really a great learning experience. A lot of things, a lot of great takeaways I've incorporated in my own business. And then just as valuable things that I say, ooh, that didn't feel good when I was an investor. I don't want to do that. So a lot of good lessons learned. So that was really the start. But when I started investing actively on my own, it really was the first property was a little 29 unit in Indianapolis. It was a 70s motel conversion.
Oh, wow.
And it was a C-class property, had a gravel parking lot. So I immediately thought, well, there's
Oh,
value if I can just
man.
pave this thing. That's going to create a ton of value. And it needed quite a bit of work. And so, but we took that down. I did have a few partners in that deal, but really I was actively managing what was going on. We saw an opportunity to turn 29 units into 33 units. So we created four more units and some empty space, which was a great value add. We really fixed up the property, paved the parking lot, really changed the appeal. And yeah, I mean, that one's been a fantastic investment for us. We still have it today. And I think we're somewhere around a 15% cash on cash return right now. It's just cranking off cash for us. And it's like the little project that could.
Yeah, no, that's great. Perfect time to buy as well, right? Back then, and just really
Yeah.
low basis, and before the word got out that multifamily was a great asset class, right? Those that knew, they
Yeah.
knew, and those that didn't, just hadn't yet learned that. So let's
That's
talk about
right.
that, which is curious because the timing of even when you were deploying that capital into as an LP into other investments with
Hmm.
other sponsors, the today, I mean, alternative investments, it's in your face. I mean, you go scroll in the feed of Facebook,
Yep.
Instagram, LinkedIn, just Google search real estate investments, and you'll find pages upon pages of different paid ads for various syndication offerings. 2015, that wasn't necessarily the case. While they were readily available, Reg D 506Cs allowed general solicitation at that point in time. It didn't have the exposure like it has today. So you had to dig a
That's
little
right.
deeper, right? And so I'm just
That's
curious
right.
how how you networked and found the various opportunities in the sponsors that you ended up investing in.
Yeah, it's kind of interesting. My first two investments were actually through a crowdfunding site.
Okay.
And so I had found out about, these crowdfunding sites, right? You go on there and one of them went well. The other one, I lost all my money.
Oh
So
no.
it was,
Wow.
yeah, it was a little bit of a rocky start. But I mean, honestly, I say that because it's important for folks because the reason I lost my money is because I didn't even know what due diligence was. I didn't do my diligence. I kind of trusted that the site was doing it and that, they had looked in the background of these folks. And the guy I invested with ended up, committing fraud, essentially lost the property. And I mean, I'm still in it today, technically, like it's still out there somewhere. But that
Oh my
was,
gosh.
a little bit of a rocky start. It wasn't enough to deter me though. I realized that it wasn't the asset's fault. It was the sponsor's fault, which I think is an important lesson learned for people is, the sponsor is so important.
Yeah.
But then from there, I realized, wow, this is not a good way to do this. And I started listening to a lot of podcasts at first. I started reading a lot of books, and then that led to attending conferences of some of the people of the podcasts I was listening to. And
Hmm.
then once I really started networking, I started just understanding the importance of meeting the people that I'm going to invest with and really having conversations with them, understand their backgrounds, and just really understanding like what due diligence really is as an investor. And so, you pay for your education, right? One way or the other. And
Sure.
so some of that was tuition. So we'll chalk it up to that. But yeah, I mean, really, it really started with podcasts and books at first.
Yeah, no, fantastic. I mean, the amount of information that's out there that's free, it's almost overwhelming. The amount of information it takes, quite a bit of time to sift through it and
Yes.
find the good quality, quality info that's out there that's relevant and applicable to you and your business and kind of the strategy that you want to take on.
Yeah.
15 or 20 years ago when I got into the business, that wasn't the case. I was scrounging to find cassette tapes and CD programs,
Right. Right. No, I
or
know
just
it's,
trying to go to local networking groups, or it was really really
yep.
challenging. But today it's the opposite problem, right? Like there's almost too much information out there,
It
information
really has
overload.
changed in the past couple of years. I mean, because
Yeah,
even in like 15, when I was really getting started, there wasn't very much information. There were a few podcasts out there, but podcasts weren't anything like they are now. Yeah, now it's almost everywhere. And I think it's great because
yeah,
I personally believe that alternative investments are what makes a complete portfolio. I think everybody, if you want to be really diversified, like your financial advisor will tell you that means stocks and bonds, right? Maybe some crypto nowadays, but there's a whole lot of other things out there that you can invest in. And
that's
that
right.
was really what was eye-opening for me, and really understanding what true diversification looks like, and really wanting to just broaden my horizons. And it took some work, but I mean, it's easier than ever right now because that information is in your face. You can find out about all different types of investments and figure out the strategy that works for you, you know?
Yeah. So talk about your business today, Hudson Investing. Maybe recent activity. I mean, what's your business look like today? You launched it in 2019. Obviously, we had a couple of years where interest rates were at all-time lows, probably lots of transactional volume, and then
Yep.
ultimately at the end of 2022, rates started on their historical climb, and now we've been stuck in this somewhat, yeah, I guess for some maybe stagnant period of
Yep.
time, just historically low transactional volume, basically the opposite of what it was like for a few years. And
Yeah.
just curious as to, I mean, maybe what your business looked like then, what it looks like today, and then what do the next 3 to 5 years look like? What are you excited about?
Yeah. No, it's easy to talk about what it looked like then. It was me. And then I had an intern,
Yeah.
who was a guy that found me through my meetup, and was in college, and he started underwriting for me. So that was really easy. And yeah, we started off strong. We started off really focused on workforce value add. That was kind
Mm.
of the in vogue thing. If you think about that time frame of like, 17 to even like into 2020. And then, as we saw, I think where we've seen the market go is really as interest rates have risen, really a shift in that, just from my standpoint, we haven't seen the value in the value adds like we used to. Just, I
Hmm.
mean, price per door has gone up quite a bit. Cap rates, are pretty much right on top of each other, or were for a while, from Class A to Class C. And so we really, in that time, transitioned really to focus on newer, nicer properties. I think if you look at the
Hmm.
average age of our portfolio now, it's probably about 2000, excuse me, about 2005. Newer product, a little nicer product, and just safer in kind of taking a more defensive position in like 22, 23, and even 24. So like some of our most recent acquisitions were some brand new townhouses, 84 townhouses we bought during lease up because we saw a great opportunity, where the builder wanted to get out of them.
Hmm.
Because they didn't want to hold them long term. They had built them, and they needed to get out. So we saw a great opportunity to come in for a good basis. We bought another property built in 2008. That was a student property that we felt we could convert to conventional. And then we bought a property built in 2008 as well, a 60 or a 55 and older community,
Hmm.
that were really transitioning from being just kind of you have to be 55 and older to live there, to be really an active adult community with activities and different things going on. We're going to add some amenities, pickleball courts, stuff like that. But we've gotten creative. I think to survive the past couple of years, you had to be kind of just more opportunistic, and
Hmm.
you couldn't just go out into a broker and say, "Hey, I want to buy a value add property." Right? There just wasn't good deals out there. If you were going to probably overpay relative to the risk. So we found unique opportunities, buy things in lease up, find distressed owners, find owners that are more interested in selling now than for the highest price, right? And
Hmm.
and we were able to pick up some good opportunities, and we haven't grown like I expected. I expected a growth trajectory kind of anchoring off of what I knew from 15 to 19 when we started. But we've had meaningful growth and I think responsible growth, and
Yep.
we've added a couple hundred units a year to the portfolio. We've got about 1,000 units right now, and but it's solid. It's solid, and it's a good base now. Where I think you asked over the next 3 to 5 years, I'm very excited for where things are going to go because I feel like we've made it through the valley. We survived. We're still here in business. We've even managed to grow as others were contracting, and I
Hmm.
feel like we're really poised to take advantage of the next few years, which I think as rates come down, I think as inflation cools off, I think as now we're through the election, I think just as we have more stability, I
Yep.
think I think transactions will come back, and I think we'll be in a very good time for real estate. And
Yeah.
so, pretty
No, that's
excited
great.
about where we are.
No, that's exciting. I mean, yeah, you're making moves when many others aren't. So that's I would say that's a success in and of itself. So well, I'm curious though, the 55 plus community,
Yeah.
what does the management of that look like, or how does it differ than that of a traditional, apartment community?
Yeah, it doesn't differ much because we're
Okay.
not offering any services.
Okay.
We don't have an operating company that's providing, it's not like an assisted living or something like that. It's really more just it's more just on the advertising. I mean, it's not even deeded that it needs to be 55 and older. But where it does differ is we have an extra person on site that is really essentially a community coordinator.
Hmm.
And that person's job is to really create that sense of community, to create events, have an event schedule. We're bringing people in, we're taking people out. Um, and we just acquired the property about 6 weeks ago. So we're just on the front end of this. But that's really where I saw the opportunity was to take it from just a 55 older community and turn it into this active adult community, right? Where you have folks that want to go out and they want to be a part of a community, and we could create great events for them, and we could really um, create, I think, a special place where people want to live for the long term.
Yeah.
And yeah, and for me in this environment, I saw the ability to have long-term renters who pay on time and really have a very solid cash flowing property kind of right out of the gate. We're able to assume great debt, and really had a unique, I think, cash flow opportunity you don't always see right now.
Any type of premium, apples to apples to another similar build quality apartment complex in the immediate vicinity? I mean, is there
Yeah,
a
you know what's interesting is we haven't enacted because we just took over, but we haven't enacted any premiums yet. But I've read a few research studies, and if you can really implement kind of this active adult community well, and people will pay 15 to 30% more to
Mhm.
live in a community. If you're just looking apples to apples to the market rate across the street, to live in a community that doesn't have kids and families and really has an event schedule and kind of
Yeah.
allows you to live that active lifestyle. Yeah. So
No,
there is an opportunity.
that's great. Are there any other considerations on a property like that? No, I don't mean to just hone in on this one particular property, but it's
No.
interesting and it's unique and it's a new strategy. We're very familiar with it in the manufactured housing space. We have a
Yeah.
number of 55 plus, age restricted communities. So very familiar with the model, but again, manufactured housing is very different than that of a
Yeah.
apartment complex. So considerations, single story versus
Yep.
multi-story. Obviously, you've got, aging considerations, but people walking up and down stairs. Does this unit have, or does this facility have an elevator?
No,
Uh,
so it's really more BTR style where
okay.
it's like quads or tries,
Okay.
but they're all in a row on a street, very much a neighborhood feel. They're ranch style, single story. They have
Got it.
attached garages. I think it would be difficult to do this type of community with multiple stories, without attached garages. So I think the developer built this really intentionally, for people, as they continue to age. The one thing it really lacks are amenities. There's really no
Hmm.
amenities. I mean, it feels like you're living in a normal neighborhood, which is great. There's a clubhouse, really no amenities. But as part of the purchase, we bought the 5 acres directly adjacent. And the plan is to build some additional units, but also to add some amenities. So,
Hmm.
plans to add a pool and add some pickleball courts and really create, again, kind of like I envision in my mind as this kind of resort style like community here in the suburbs of Indiana that really will attract people as they downsize.
Yeah, no, that's great. We actually just added pickleball to one of our communities in Ohio, and it's been of all the amenities, it's been the biggest hit of them all,
Yeah.
across the board. It's been massive. Like they've done tournaments. I mean,
Yeah.
interestingly enough, we don't even have. There's no activities director there. They've taken upon themselves. We got like this, the individual that spearheads all the tournaments. I mean,
That's awesome.
at least 5 days a week, there's a waiting, a waiting line to get on the courts. So
I mean, I love
it's
hearing that. I mean, that's exactly what we're going for, with this
yeah.
community. And really it was, that really is, I think, the value driver, as well as being able to build some additional units on the adjacent 5 acres. And so I think that it's a solid cash flow, and I think that's how we'll create additional value.
Yeah, I think there's a great opportunity to really, find your niche, and maybe this becomes it. Maybe you guys have a massive success here with this, and you find that there's just a way for you to number one, create a really cool product, but also squeak out higher than average returns than that of what a
Mhm.
traditional multifamily might look like. And so, very cool.
Yeah.
Excited to hear how this goes for you.
Yeah, I appreciate that. And it's like I'm a big demographics guy, and I'm always just looking at demographics to kind of drive where we go. And it's like the stat for 2024 is like this is the peak year of people turning 65. There's like 11,200 people a day that are turning
Hmm.
65. And so, you just look at the need for this type of housing, and I mean, I don't think it goes away for the next 20 years.
Yeah, and there's plenty. I think a lot of people think that once folks get to that age and they're looking to maybe downsize or move to a more active community, that they're going down south to the Sun Belt, and that's just not the
Mhm.
case. There's plenty of
Yeah,
folks that want to stay near their immediate family. They don't want to be snowbirds. They want to stay where they grew up, where their rest of the family lives, and where their grandchildren live. And
yeah,
but they want some more amenities. They want that activities director. They want that active adult lifestyle and be around other folks of the similar age that have similar interests. So. Anyway, I think a lot of people when they think of retirement communities like that or active communities, it's always somewhere in the Sun Belt region.
for
It's not,
sure.
so you don't really think of that in Ohio or Indiana or those types of Midwestern states. So, but it definitely exists. In fact, we're actually we're in contract right now in a 55 plus community, mobile home community in Missouri, but it's a very basic. It doesn't have swimming pools. It doesn't have clubhouses. It's a very nice, clean community,
Yeah,
well organized, well run, but it's in outside of St. Louis, Missouri. It's just a nice, clean, affordable place for folks of 55 plus age group to live and to live together near one another.
for
Maybe
sure.
they don't want to hear the crying kids. They don't want to hear the screaming kids. Oh, they have grandchildren, but they can give the grandchildren back, right?
That's right.
That's
That's
the
right.
idea behind it. The
That's right.
grandchildren, they come visit for a day or two, but then they pass them back to mom and dad.
That's
And
right. You don't want
so
them
they can have
above,
peace and
below,
quiet.
or next to you. Yeah, that's
That's right.
exactly right.
That's
But
right. So
yeah,
you go ahead.
I was just gonna say that's one of the type of projects we're working on. And then I would say the other thing that has really changed for us in the past couple of years is getting into new development and building ground
Okay.
up. And that was not something that I ever anticipated getting into when I started this. And it is a completely different animal. But honestly, in a time where transactions were slow, it was great for us to have that diversification and for us to really sink our teeth into a ground up development. And we're about to deliver here at the end of December, 80 units,
Wow.
kind of in the suburbs of Indianapolis, Class A property in a really fast growing town that has kind of, Indianapolis has grown out and around. And it's a town that's been great to partner with. I mean, they haven't had any new market rate multifamily built there in the past like 25 years.
Wow.
I think we own the last one that was built there, which is really what turned me on to the town. And then when we bought the land next door, because we saw the opportunity and decided to build right next door. And so, that's been a whole host of challenges, but also really gratifying, really cool to see something come out of the ground like you envisioned. And we're we're looking for new opportunities like that now all over Indianapolis as Indianapolis continues to just grow like gangbusters.
Like, how far away is that from the core of Indy?
If
45
if you wanted to
minutes or
be, yeah, if you wanted to be downtown, you're probably 30 minutes.
okay.
But I mean, honestly, downtown isn't even so much the core anymore. It's more like the north side as
Hmm.
just the trends that started in COVID kind of haven't necessarily turned around, you
Yeah.
know? And so if you want to, what's interesting is like one of the fastest growing cities in Indianapolis is called Fishers. It's a northeast suburb and it essentially has grown out and around this small town and I mean you're just completely connected into the main restaurant corridor. You're probably
Hmm.
10-15 minutes away. And what's amazing is some of these really high-end restaurants have come to this small town called Fortville, Indiana, because of the quaint kind of nature of it. And so you've got these breweries and distilleries and restaurants that now are on this main street in this small town. And that was really what attracted me there. I was like, wow, they got a lot going on. And
Yeah.
it's great when you see a small town that's actually investing in their infrastructure, right? They're
Yep.
investing in their main street. They're building out their roads. And that was all that really attracted me to that. And I saw the growth coming when we bought a property there in 2021 and it just continued to move out that way. So it's been a great first project.
Yeah, that's great. It's always exciting when you see the breweries and the little boutique, shops and
Hmm.
restaurants come to
Hmm.
those little towns, right? Like that's just it brings energy that
Yeah.
that that hadn't existed there probably in quite some time. So,
Yeah,
what
absolutely.
what do you guys project as far as your lease up rate? I mean, how many units per month in that project?
Yeah, it was we're 80 units. We projected a 6 month lease up. So
Okay.
what's the math on that? We're about, 12 or so, 12,
Yeah,
13. And
that's great.
we've started pre-leasing and we've had a great response. The We've had a great response. I mean, really the idea was instead of living in some of the more congested areas of town where, you've got brand new Class A property going up, live a little further out, but just 15 minutes or so. And you get this quaint small town kind of, Main Street USA experience. You get the
Hmm.
walkability of walking down Main Street to the breweries and the restaurants. Um, and you can get it for probably $400 less
Yep.
per month than if you lived 15 minutes away in some of these more congested areas. And so that was really the idea of it was we could really be this value play and really attract people to this small town. And
Yeah,
so it's really
that's
been cool.
great.
It's been a partnership with the town. The town contributed some of the financing and really made it work for everybody. And so it was really it's a cool project to see come to fruition finally.
Yeah, that's exciting. Yeah, kudos to you. So, as we work to wrap this up, and you can't use the crowdfunding deal, but I always like to wrap this up with, have you sharing a story there's always challenging deals. Every deal has got its own respective challenges, some more than others, and then there's the ones that keep you up at night, give you some additional gray hairs, make your hair fall out, right? Just cause undue stress and challenges in your life, and
Yep.
and
Yep.
sometimes they drag on for longer than what we had hoped, and so with all that being said, obviously, you had that one financial challenging one with the crowdfunding deal, and so, but we can't use that one. But I'm sure there's plenty more. At least one that rises to the top behind that one. Maybe share some details of it. What were the challenges? Did you overcome them? If so, how did the deal turn out? And just again, some context to it so that we can take some lessons away from it.
Yeah, yeah, absolutely. Well, one that comes to mind right away was, we bought a property in Cincinnati. It was 132 units. We still own it today. Um, and we had been growing pretty rapidly at that point, but our properties were mainly in Indianapolis and then down in Louisville. This is our first one out in Cincinnati. And we had been growing with a property management company that was fairly small. Um, and as we started growing, we really started seeing the cracks in their systems as they were trying to grow with us. And unfortunately, this was the kind of the straw that broke the camel's back. This property out in Cincinnati, and so really, it was a property that should have just taken off like a rocket right away, but instead, we found ourselves at 80% occupancy and heading down and
Mm.
just trying to get our arms around why. And we're being told things that we found out later weren't true. And just really trying to manage that. And this was when it was really a lot of it was just me on my own. I didn't have a team yet. Like right now I've got a VP of asset management who's been in property management for 28 years. She sniffs this stuff out day one. But back then it was just a little bit different infrastructure on our side. And so, we found ourselves just struggling and looking that we were going to be in the 70s in occupancy when all of the comps around us were in the high 90s. I mean, there was no market reason why we should be there. It was just
Hmm.
bad management. And so we had to make the tough decision on, do we try to claw our way back, or do we make what we know is a huge disruption and switch managers, right? When we're already at a low occupancy and potentially put ourselves in a worse situation, or do we trust what the manager's saying that they're gonna get back? And ultimately, we made a decision to cut bait and find a new manager. And it took us about a year to claw back. And ultimately we were able to get to trend to about 97, 98% occupancy. But it really was an unfortunate situation that came from poor management, dishonest management, and just really, I think they weren't built to scale, and we scaled too
Yeah.
fast. And then instead of owning up to it, they tried to cover it up, and did cover it up successfully for a while. And
Hmm.
it just put us in a bad situation that we had to end up really climbing out of. And luckily we did, because the market was strong. We did a good job picking the right market. It was a great asset. We put a lot of money into the asset. And so ultimately it came around, and, we spent most of this year at about 97% occupied. So
Wow.
felt really good, but it took about a year to get back there from being down like 78, 80%.
Wow. What were some, like, what were the top two reasons that you feel that they just, missed the mark? I mean, obviously they tried to scale too fast. They had some internal infrastructure problems.
Yep.
But like, what were like the big ones? There was probably like one or two just items that were glaringly obvious that they did wrong.
Well,
What were
I
they?
think one big one was they didn't have the relationships in Cincinnati. We were really bringing them over from Indianapolis, and they didn't have, so they were
So like vendor relationships. Is
vendor
that, yeah.
relationships. Yeah. I mean, and so they were telling me, oh yeah, we've got all this. I know people, my network, all this. But at the end of the day, what I found out was, I mean, they were essentially just calling people out of the phone book and bringing them over. And so we were spending on, way too much money on vendors. We had
Mhm.
bad vendors. We were churning through them. And it really helped me understand how critical it is to have that kind of Rolodex of trusted contractors,
Yep.
trusted vendors. Um, and that I really needed to be mindful of that when we thought about property management. And we really need property managers that are kind of tried and true in that market and have those Rolodexes if we don't ourselves. So that was a big takeaway for me. And I think the other one was, I mean, honestly, if they had just been open and honest about what was going on, I think we could have helped them solve some of the problems.
Hmm.
I'm very much a roll up my sleeves type of guy. Like if I need to take trash out in the hallways, I'll take trash out in the hallways.
Yeah.
I'll do whatever I have to. But instead, it was kind of like this. Oh no, everything's great. Well, where's the reporting? Oh, reporting's kind of down. We're transitioning, whatever reason. It goes black for a while. When it came back on, it was like, whoa, what's happening? And so it's kind of just, I think if they had been fully transparent, I think we could have avoided some of these things.
Yeah. Interesting. Well, I'm sorry you had to go through that, but again, live and you learn, and ultimately you're stronger because of it. So,
A ton
um,
of lessons learned, man, right? A lot of this is
yeah,
lessons
yeah.
learned. And thankfully, because we had investors in that deal, I mean, thankfully the deal has come around, and we've put some extra cash in when we needed to. We've done what we needed to do, like at the GP level. But now it's
Hmm.
come back around, and I think it's got to be one of our best. I'm sure it is one of our best operating properties from like a expense ratio standpoint. So
Yeah, that's great. That's great. Well, Kent, for those that want to learn more about you and your group and, the things you guys have going on, where's the best place to track you down?
yeah, you can just go to hudsoninvesting.com. That's the easiest way to track me down. You can also find me on LinkedIn with Kent Ritter. And or you can check out my podcast, which is Ritter on Real Estate. So there's several options, but if you want to know about investing, kind of what we do and see some of our current opportunities, it's really hudsoninvesting.com.
Okay, awesome. Well, Kent, man, it's always good catching up with you. Great to have you on the show and learn a little bit more about your story. And hopefully our paths cross soon.
Absolutely. Thanks, Kevin. Always a fun time.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.